Okay, we're good. Good afternoon, everybody. Welcome to the first stream of 2026. Hope you all had a great time, great festive season, and that you are ready to take on the year. Got lots of rest, spend some time with the families, get to wind down a little bit, and yes, we are ready to take on this year. We've started trading already. Those of you in the group, we started on Monday already, and there was a little bit of a mix-up with the stream. I kind of forgot about it on Wednesday, so we're doing it today. Next week, Wednesday, we'll be doing a stream again. So we're going to do this weekly during the course, during the time slot of the last trading session on Wednesdays. So stay tuned, tune in. This is a great time to ask questions live. I can answer them while we're busy streaming. The chat's available. I can see the chat. So it's a great time to ask questions about stuff you're not sure about or stuff like that. Tune in and hope to see this stream event grow weekly. Today we're going to talk a little bit about the stochastic oscillator. We're going to look at it. It's one of my favorite indicators. We're going to look at what it does, what it shows you, and common mistakes that people make using the stochastic oscillator. It's a brilliant indicator. It's been around since the 1950s. So we're going to have a look at that, and we're going to look at effective ways to use it and how to avoid common mistakes. Okay, so let's get to it. We've got our chart, and we're going to add the stochastic oscillator to our chart. Okay, so there we go. That's the stochastic oscillator. It consists of a K line, which is usually blue, and a D line, which is usually red or orange. The K line is the raw data line, and the D line would be a moving average of the K line. Okay, so if we open up the settings on the stochastic oscillator, we will see that we have a K period. This is calculated. This calculation takes into account this period will be the amount of candles we look back. So it's currently set to 14, which means that the current value is calculated using the last 14 candles. The D period we see is set to 3. This will be the moving average, or the average average value of the last 3 K values. So you can play around with this. You will see, if we look at the way the stochastic looks now, if we increase this value here, we will see that the green line starts smoothing out. Let's make it 20. We will see that the orange line starts smoothing out quite a bit. Okay, so because the higher your moving average becomes, the more data it takes into account, the more it will smooth out. Okay, so the default for the stochastic on basically always is 1433. There's a smoothing period as well. This just smooths out the K line a little bit because it can become very erratic at times. Okay, but we're going to use it on default values today. We're not going to mess around with any of the values. It's good enough as it is. Okay, so when we talk about the stochastic oscillator, this is usually one of the first indicators that especially new traders see everybody use, and they start using it as well. And we need to understand, first of all, that the stochastic is a momentum indicator. It calculates momentum. In fact, the stochastic shows you the change in the average closing price. Okay, so it calculates, it shows you momentum, and this is something that a lot of people misunderstand when they start using the stochastic oscillator. One of the things you hear people say quite often, when the stochastic oscillator hits overbought, it's time to sell, and when it hits oversold, it's time to buy. And if we look at this chart here right now, the stochastic oscillator, for example, hit the oversold area at this, when price was at this level here, and we can see how much further down price actually went. Same goes for when it went up. We hit the overbought area around this price area here. There we go. On this candle here, we hit the overbought area, and the stochastic simply stayed in the overbought area for quite some time, and we can see that price is still busy going upwards. This is one of the most common mistakes that people make when they use the stochastic oscillator. I almost never basically never take into account the oversold and overbought areas to find entries. Because the stochastic oscillator is a momentum oscillator, it means that the higher the RSI, the stochastic gets, the the faster the change is in the closing prices. That's telling me that we're gaining momentum. So I don't want to go against it. And the same goes for when price is falling. The more price is falling and the lower the stochastic goes, the more bearish momentum you have, and the more difficult it becomes for price to simply stop and turn around. So if you start using it the opposite way, to think of the more momentum something has, the more it tends to go in that direction that it's currently moving, you're going to start looking differently at the stochastic oscillator. There are times, and we will have a look at that in a minute, there are times when you can use the overbought and oversold levels to determine entries. We'll have a look at how to find those areas, but for now we're going to first have a look at why the first thing we want to look at is why we don't sell when it's in overbought and why we don't buy when it's in oversold. I totally spaced out now. Apologies for that. A stochastic oscillator. Okay, never mind. So if we look back at the price history, we can see that quite often when the stochastic does hit the overbought and oversold levels, it does tend to push back a little bit. It doesn't necessarily mean that price will reverse. It simply means that we're taking a rest. It could be a correction and we could actually continue the direction down. Here's the point I was going to make. So the stochastic hitting the overbought area doesn't mean it's time to sell. It shows you that at the moment there's very aggressive buying. You can kind of think of it like a rubber band being stretched. When we move into the oversold and overbought areas, that band is stretching. We're stretching the rubber band to its starting to near the maximum capacity, stretch capacity of that rubber band. So eventually price will snap back, but it's extremely difficult to determine that simply by using the stochastic oscillator and the overbought and oversold levels. So how can we determine when we can and cannot use those levels? It's fairly easy. Let's go to a 5-minute chart. So what we're going to, one of the times, okay, this is not going to work. We can actually go down the list. There was a data release for sure. We covered in previous streams, over the last 2 months, we did have a look at how to draw support and resistance areas properly, and we did have a look at channels and ranges. So if we look at this area here, for example, let me get my drawing tools out. We're going to do a quick channel here, or parallel channel. I'm going to use it like that. Once you determine that price is currently moving in a range, if you can see the range and you've determined it's a valid range, then you can, that's the only time you should really use overbought and oversold areas to determine entries. And these will need to occur on the channel areas, on your support and resistance areas of your range. You can then see if it rejects. If the stochastic starts leaving the oversold zone, you can start looking for entries in the direction that we're bouncing in. So if we look, in this case, we would have had a buy. If you took a buy for 15 minutes or something like that, on this candle here, or even that one there. So if you waited for the stochastic to leave the oversold zone, showing us that there's a change in direction, that's where you can use the overbought and oversold areas to determine entries. This is the only time that I will use the overbought, oversold areas to find an entry is once I establish that the market is in a range. It happens during the day on some assets. Yeah. So once you spot it, you can use it to your advantage, but this is the only time that one should use overbought and oversold levels to find entries. Same goes for when we are in sideways channels. Let's see if we can find a good example quick of a downwards or an upwards channel. Oof, this is chaotic. So price started moving into a channel here. It looks like, anyway, let's see if I'm correct on this. We're all moving in a channel, although the bottom of the channel is a bit sloppy. But this is areas where you can use, this is also just price trapped in a range. You will see this, again, you will see this on assets throughout the day. Not happen very often, but it does happen. Don't expect it to see it on every asset as that you look at, but you will see this happening at some stage, at some point on every asset. This is not the best example actually here, but this will have to do. So once you determine that price is stuck in a range, whether it's a flat range like this or a channel running upwards or downwards, you can definitely use the stochastic along with the channel. Channel support and resistance. You can definitely use the stochastic overbought and oversold levels to find an entry, but that is the only time that it will be fairly reliable. Of course, there will anything can happen. There will be times when it shows that it's turning and then suddenly just goes out of the channel. This does happen. Losing trades is part of trading. We cannot avoid that, but this will give you a very much an advantage if you can find price trapped inside a channel and then use the stochastic overbought and oversold levels. Let's have a look quick at one of my absolute favorite ways to use the stochastic. So one of my favorite ways to use the stochastic is to find divergence on the chart. Now this will be both normal divergence and hidden divergence. The stochastic oscillator is really good at that. Hidden divergence is a continuation divergence. So you will find that in a trend, while price is moving up or price is moving down, you will continuously find areas where the stochastic makes hidden divergence. And then usually when the stochastic starts making normal divergence is a reversal signal. So you will find that usually when you start seeing normal divergence, price is getting ready to make a turn to the opposite direction, whether it's normal bearish. If it's normal bearish divergence, we can expect the price to start climbing for a bit. If it's normal bullish divergence, we can I'm sorry, I got that one around. If it's normal bullish divergence, we can expect price to start climbing soon for a bit. And if it's normal bearish divergence, we can expect price to change direction and start going downwards. So let's have a quick look at what this looks like. And the great thing about this is that you can use this on any time frame. I'm going to look at the 1 minute quick, see if I can find some examples of some decent divergence. Okay, we had an opportunity here. This was a trade opportunity this was normal bullish divergence that we had here. Our entry would have been somewhere around these two candles there. This would have been a buy entry. Because we're on a 1 minute chart, this would have been anything like between a 3 and a 5 minute trade for me. What divergence looks like will be this. We know that when price is moving in a bearish direction, when we are in a bearish trend, we identify it, a bearish trend, by when price makes lower lows and lower highs. This will be the lower lows, and this will be the lower highs. Those four there, and these are the lower lows. So every time price makes a low, it's lower than the previous one. Every time price makes a high, it's still lower than the previous high that price made. That's the definition of a bearish trend. And then the bullish trend is the opposite, price making higher highs and higher lows. So for divergence, we're going to look for normal. This is normal divergence, which is a bullish divergence. This is normal bullish divergence. So we're going to look at the lows for normal bullish, because if it's bullish divergence, price is going to be pushed upwards, and that's why we look at the bottom. We push from the bottom, and we push up from the bottom, and we push down from the top. So for bullish divergence, we look at the lows. In this case, we had price make a low here. It pushed back a little bit, made a high, but this was still a lower high, and price came down even more. If we look at the way that the stochastic behaved during this, we can see that the stochastic made a low here and then made another low, but this low was higher than the previous low. So this means that the stochastic is making higher lows, but price is making lower lows. That's what happened right here, and this would have been, like I said, a buy opportunity. And one of the things I get asked most frequently is, how do you know when to enter? When you get divergence like this, when do you actually enter the trade? The answer to that is extremely simple. When we get the crossover on the stochastic, that confirms the divergence for us. So that would have been, like I said earlier, on one of these two candles, we did have, if you look closely, we did have a crossover there already, although it was fairly difficult to see. So even if you did not take it on that candle, we could have taken it on this candle as well. Like I said, it's because it's a 1 minute, a 3 or 5 minute trade for me. That's it. I don't take the longer trades on divergence. When you see bullish and bearish divergence, it doesn't mean that price will continue. It's time for a reversal, and price will simply continue in the opposite direction for hours. It doesn't mean it's necessarily a reversal, but it does show you that we can expect at least a correction, like we saw here. This is just a correction in the current move, and we can at least expect a correction. When this divergence takes place, you don't know whether this is going to be a price reversal and price is going to continue upwards indefinitely for a day or so. You don't know. There's no way we can predict that. That's why when we're trading options on a 1 minute chart or on a 5 minute chart, we just take the divergence for a couple of candles. If you were trading Forex, if you saw divergence like this and you're trading Forex, you would have taken an entry and you would have had a stop loss around here, somewhere around this area here, just below the divergence. You would have had a stop loss. And so if the divergence continues and it is a reversal, you would have been good. Otherwise, you would have been protected and got stopped out and only had a small loss if you were wrong about that, if price didn't continue its way up. So this would have been the case here, although you would have made money on this if you played this diversion, because your stop loss would have been somewhere around here. And by the time price was here, your stop should have been moved above break even anyway. So you would have gotten stopped out for break even, at least break even, and not lose money on a trade like this. So that's how we would have done Forex. But for options, like I said, 3 or 5 candles, depending on your time frame. If you're trading on a 1 minute chart, it's going to be 3 or 5 candles, so that's going to be a 3 or 5 minute expiry. If you're trading on a 5 minute chart, it's still going to be 3 or 5 candles, so you're looking at a 15 minutes or a 15, 20, 25 minute expiry. Okay, so keep that in mind. It's not about the time, it's about the amount of candles that passes, that plays out after the divergence formed. Usually divergence needs a couple of candles to play out, so don't get too excited. If you took the trade on this that we discussed now, if you took it on that candle there, this one would have been red. There's no need to, that's why we don't play just one candle ever on divergence. But a 3 minute trade, that was the close there, that was the close of a 5 minute trade. So it's good. A couple of candles for the divergence to play out. Back to the stochastic. So that's the one way, this is my favorite way to use the stochastic oscillator. Finding divergence in the charts, whether it's hidden divergence or normal divergence, both of them works really well. The stochastic shows both of those extremely well. Let's see if we can find a quick example of normal divergence. Of hidden divergence. So this would technically be an example of hidden divergence. Remember earlier we said we know that we are in a bullish trend if price is making higher highs and higher lows. Because it's bullish divergence, we're looking at the lows because we're pushing upwards for bullish divergence. If we look at this low here and then this low here, if we look at these two lows, this is clearly a bullish trend. We can see that this last low here is much higher than this low here. We can see also that price is making higher highs as it's going along. But if we look at the stochastic from the two previous lows, that was the low that the stochastic made when price made this low. But on the next low, which was much higher in price, the stochastic made a lower low. So this is hidden divergence, or hidden bullish divergence in this case, in which will be a buy signal as well. And again, we wait for the crossover, which would have been that candle there. Let's just mark it quickly. Would have been that candle there. And here's why beautiful example of why we say 3 to 5 candles. A 3-minute trade would have not have been the great here, but a 5-minute trade would have been good. We played on the crossover. This was the candle that confirmed the crossover for us, so we just went with the direction that price was going. And once the stochastic turns up like this, you must remember we started off with the stochastic being a momentum indicator. So once we get that bullish crossover, it's showing us that the bullish momentum, that we've switched to bullish momentum, and it's increasing at the moment. Same goes for bearish crossovers. Once the stochastic makes a bearish crossover, we can we know that we're losing bullish momentum and we're starting to gain bearish momentum. It's as simple as that. So you want to look for crossovers. Crossovers are quite crossovers is a thing I use quite often, depending on the, never by itself, but depending on the situation, I actually use crossovers quite often. Crossovers would be, let's have a look. So these are the indicators that I use during the day when I'm trading. I do have a few other ones, but if we look at them, let's just have a look at the moving averages quick. Okay, so we know that when we have a moving average, when moving averages on the chart, price often use those lines as dynamic support and resistances. We did cover this also in a previous stream. So if you missed that, go have a look at the stream about, at the video about moving averages. We did take some trades with those as well. Now, if we understand that sometimes price uses the moving averages as a dynamic support and resistance areas, then we can start looking at areas like this where price hits support and we get a bullish crossover on the stochastic. Okay, so this kind of ties in with the support and resistance that we did. Where would the trade have been? Trade would have been on this candle, yeah. So if we had a buy on 3 or 5 minute buy on this, would have been good. This is where I use the crossovers of the stochastic. If we have a decent support level, this could also be support like this. Okay. This is a resistance level. Price hit this level here. And as price was going along, the minute this started happening, you would see immediately that price is struggling with this level again. And we can see that the stochastic is in the oversold area or overbought area. As soon as we get the crossover and stochastic starts leaving, that is a sell opportunity for us. So it's using the momentum combined with something else. So keep in mind that remember that the crossovers is showing us that the current momentum is taking down or slowing down, and we're starting to gain momentum in the opposite direction. again, we can't use the crossovers by themselves. If you were going to try and trade crossovers by themselves, it's not going to end good. But if we support it with something like support and resistance, we can then start to determine this will be a good idea to take a sell here on the crossover as the stochastic is leaving the overbought area. If we took there was a crossover as well. We had a crossover here in the middle of nowhere. There was no support or anything close nearby, no resistance. If you sold that crossover there, you would have had a bad trade. So we cannot play crossovers by themselves, but we can definitely use the support and resistance areas as they form to find entries. There was another opportunity on a support. Okay, so we had this area here where price came down, it went up. Now when this happened, you had no idea this is going to be a support level. But when price hit for the second time and started rejecting, pushed through and pushed upwards, we could have started taking buy trades here. On the crossover, we could have used the crossover here to determine that we can actually start taking a buy trade because this support held. Okay, that's the way to use the crossovers. Using them by themselves is out of the question, and you're also going to find, if you do try to use them by yourselves or by themselves, you're going to find this happening a lot, especially in the overbought or oversold zones, where price has a lot of momentum, and the stochastic simply is alternating between the K and the D line. You get a bunch of the crossovers, but you don't know where to enter them, where to enter on this. Okay. But these are great examples of how you can use the stochastic turnovers as a way to find entry spots, combining them with support and resistance, or combining them with moving averages. These are 50, 100, and 200 moving averages. There we go. Okay. The big takeaway from this is, like I said, a lot of people make the mistake of thinking that when the stochastic enters overbought, it's time to sell. And when the stochastic enters oversold, it's time to buy. This is the worst thing you can really do with the stochastic. The stochastic was built as a continuation. It was designed as a continuation indicator. So it was designed for quite the opposite. When the stochastic is entering overbought areas, it's usually an indication that price is going to continue running upwards because we have a lot of bullish momentum. And when the stochastic is entering oversold, it's usually an indication that we are going to get more downwards movement because we have a lot of bearish momentum. And of course, this depends on what is currently happening. If we are in a strong upwards trend and there's a correction, and the stochastic comes down a lot, we're not going to expect to start selling into a major trend. Let's see if we can find an example of this. See if we can just find a good example of okay, so here we have a decent upwards trend. Okay, price has been moving quite strongly here. Then we had this correction here. Just because the stochastic is moving into the oversold zone, I'm not going to start selling. Okay, because we are in an upwards trend. We haven't broken the last low yet. You have to take all those things into consideration as well. This is why we did the streams in this order. We first discussed support and resistance, how to find channels. We discussed the moving averages, stuff like that. Because you can't use the stochastic if you don't look at support and resistance, if you don't look at trends, if you don't understand how to identify a trend. And this is the reason why every stream I talk about how to identify a bullish and a bearish trend. If you cannot identify them, you're going to struggle even more. But just because the stochastic is moving into oversold doesn't mean we can start selling. But if we are in an upwards trend, you are much more likely to be using the overbought area. As soon as the stochastic does go into overbought, this is a good example here. So we're in a very strong upwards trend. We had the correction, stochastic pull down, but went into overbought again. You could have bought when as soon as the stochastic entered the overbought area, you could have started buying, and you would not have been disappointed. This is the correct way to use it. We do not want to start selling here because the stochastic went into overbought. Okay, but you do need to look at the context of price movement. You do need to understand that we are looking for the direction, the current direction. This is when price is trending, and the rules kind of change when price is ranging, like we discussed earlier. When price is caught in a range, which does happen as well. Remember, price can always only do three things. It can go up, it can go down, or it can go sideways for a bit. It doesn't often go sideways, but it can go sideways. Sideways is one of the directions price can move. So we do have ranges. That's when price gets stuck in a range, when price is moving sideways. And usually when you look at a bigger, higher time frame, then you will see that it's just a couple of one or two candles maybe, but then beyond the lower time frames, price is stuck in a range. So those are the only three things that price can do. And the first thing you need to do is identify what the current situation is. What is price doing at the moment? Are we moving up? Are we moving down? Or are we in the range? And then you start looking at your indicators. Okay, so we're moving downwards. We are in a downwards trend. I'm only going to look for sells, but I'm going to use the oversold area to do that. Or we are in a strong bullish trend. I'm going to look for buys, but I'm going to use the overbought area to do that. Or if we're in range, you simply flip the script. Okay, I hope this clears up some of the ways we use the stochastic. There's a lot of information on the stochastic out there. If you want to go have a look at how it's calculated, all the values and all the formulas and stuff, I'm not going to bore people with that. If you want to go look at those, it's available online. Lots of websites will explain how stochastic is calculated and stuff like that, but not a lot of them actually explains the conditions in which you use it. Another thing you can use is AI, by the way. Ask ChatGPT or Grok or somebody, one of the big ones, to just explain to you how the stochastic works and how to identify entry, how to use it to identify entries. It's actually quite fun if you do it that way as well, because you can keep asking questions, ask for explanations and stuff like that. But yes, okay, so we are gonna end the stream here. Right, if there's any questions, now is the time. If not, we're going to end the stream, and then we'll start the weekend. So I'm going to give it a minute or two for any questions, and then if not, okay, great stuff. Let's see if we can, while we wait, just give it a couple of more minutes. Let's see if we can maybe find a decent trade example, actual trade example of, okay, here's a decent example. I'm on 3 minutes. I'm just going to take a buy here. The reason I'm taking a buy here is that the stochastic has entered the overbought area, and then we closed above, of course it's going to do this, we closed above the 100 moving average as well. And this is telling me that we have changed directions. We broke the previous high, because we can see here that price was making lower highs, but we made a new high here. And I'm just going to go with the direction here. Price, the stochastic has entered the overbought zone, and we have broken through the resistance as well. Let's see what happens while we wait. Again, questions? No? Okay, so we'll let this run its course, and once this is done, we'll end the stream and kick off the weekend. Maybe should have gone with a 2 minute entry here. It's looking good though. You can see it's going in the direction we want it to go. And like I said, we had price break through the resistance. When this happened, my stochastic entered the overbought zone. So I'm just going with it. It's telling me that the momentum is picking up quite a lot. There's the change in buying price is increasing. So I'm just going with it. It's that simple. It's just going to take some practice. And that's what demo accounts are for, by the way. Slap the stochastic on a demo account. Start drawing in your support and resistances and try to identify areas where you might have had trade opportunities and then try to learn from that. But that's what demo accounts are for. It's good to practice. Oh, you're going to do this to me now? Looks like it's going to do this to me. Well, we can't win them all. Yeah, this is gone. It's testing this level here now. I honestly thought it would have started going because we did break through the resistance area here. Might have been out. 5-minute trade might have been good as well. Well, it was still a valid trade in my opinion because we did break through the resistance and the stochastic went into overbought. But okay, that's it on the stochastic. Okay, so nobody's got questions. I really hope you guys start tuning in more as we go through the year. Like I said, we're going to be doing a stream every Wednesday from now on. We did start about a month or two ago. We started doing the streams every Wednesday. So tune in. This is a great time to ask questions. And that's it. I hope you guys have a great weekend. And I'll see all of you guys on Telegram on Monday. Cheers.